Good afternoon, everyone, and a very warm welcome to the Future Farm Finance Series' first instalment, the Innovating Farm Finance webinar. My name's Adam White. I'm the Head of Agriculture for Barclays Business, and I'm responsible for a team of dedicated agricultural specialists across the UK who support a wide range of businesses with diversification, sustainability, and growth. We work across the industry with agricultural membership bodies and government to understand trends and how we can support. And personally, I work with a number of agri-tech businesses, acting as a mentor and advisor to support their journey to investment. We've got a very esteemed panel today, so let me introduce them. First, we have Liz Jones, partner at Assets, and Liz is a qualified chartered tax advisor and a partner within the South Molton office. She's a member of the Institute of Chartered Accountants and a fellow of the Association of Chartered Certified Accountants. Liz prides herself on providing a proactive service to all her clients and always operates with her clients' best interests at heart. We also have Oliver Mcintyre, National Strategy Director for Barclays Agriculture. Oliver grew up on a family farm in Lancashire. After 3 years at Myerscough College, he spent 10 years managing pig units throughout the Northwest, then spent 6 years as an independent farm business advisor. In his current role as Barclays National Agricultural Strategy Director, Oliver oversees Barclays' agricultural strategy and positioning from an industry perspective. Finally, we have John Maycock, who is the Commercial Director of Propel Finance. And Propel Finance are a leading provider of agricultural equipment and machinery finance. Propel also have strategic partnerships with both Barclays and Assets to provide asset finance for our respective customers. So, just to run through the running order of tonight's session, we're going to hear from Oliver first to introduce the topic of innovating farm finance. Then John on the role of asset finance in supporting innovation in farming. And then finally Liz, who will look at the potential tax implications and considerations that need to be made. After the short presentations, we'll open things up for discussion and some of the advanced questions we've received. Now, don't forget, you can ask questions at any time. Just type them into the box at the foot of your screen and I'll direct them to the panel. The webinar is expected to last for about an hour, and afterwards it will be available on demand. You'll get an email to let you know when the recording is ready for viewing. So let's get straight to our first speaker tonight, Oliver Mcintyre.
Hi, Adam. Thank you very much. Good evening, everybody. Beautiful day in the north of England. It's a little breezy, so I will get straight into it. So I suppose, the topic tonight is innovating farm finance. We all know what pressures the agricultural industry is under, not just those day-to-day farm gate pressures, but also, the journey to net zero, the key watchwords of sustainability, domestic agricultural policy. We are entering a period of huge change, really, and occasionally challenge. I happen to think that what we're about to go through, although challenging, is actually quite an exciting period in agriculture. And in order to hit that sort of net zero emissions by 2040, 2050, in order to sort of get down the route of sustainable farming and embrace the entry level, the environmental land management scheme, and all that comes in the new domestic agricultural policy, I do think technology, innovation is going to play a huge part. So it's a question of how we go down that to actually fund it. We've got to remember that if something's really innovative and really untried, the role of a bank is to fund business, not a concept or an ideal or a field trial. But if you're in the fortunate position of having equity in the business, be that through land and freehold deeds or be that through stock and machinery, it is possible to sort of do equity release in order to fund a project. And that we would see that as a sort of transitional type blend. And that equity release can pay for the investment. Now, as a bank, what we like to see is a return on that investment. But, I think you'd probably all be surprised. It's not always a financial return we're looking for, especially in the modern world, looking forward to the next 6 or 8 years. It could be sustainability from the environment point of view, business efficiency. It could actually just be family sustainability. If you look at how some farms have installed robotic milking machines, that's actually changed the family dynamic, especially for those people with younger children. What we've got to remember is, whilst we can do this sort of equity release against farming assets, there are always other ways of funding things. It's not all about piling expenses on the overdraft, which should just be for working capital, not that capital investment. So shortly I'll hand over to John from Propel, and he can talk about what Propel can do to help fund your business and the innovation you need to get in there. I think I'll just sort of nearly wrap up with a couple of things. I have used the mnemonic, the acronym CAMPARI, many times in presentations I've done to the farming community. The first three letters of that mnemonic, CAM, stand for character, ability, and management. And I think the important thing to remember here is, when you're sitting in front of a bank or a prospective lender, everything changes in the world. What we're looking for, we know how much you want to borrow. We know what its purpose is. We know what the repayment source is going to be. It's going to be sort of business trading and improvements in efficiency. And as I've said, if it's an equity release scenario, we're probably going to have that insurance. So that's the sort of PARI of CAMPARI covered. The character, ability, and management of someone coming to us for funding is where we base a lot of our decision. Is the management team in charge of that business capable of putting the business plan together and delivering it for us? So that's the biggest challenge. I always say if you're talking to a bank for money, it's almost like a job interview. You're trying to convince that manager to lend you the money. So the better prepared you are, the more chances of success you'll have. Finally, I'll just finish with a bit of an example. I came into banking, 17 years ago now. And it was just at a time when robotic milking machines were just coming in. I remember when I was covering Cumbria and southwest Scotland, and I remember the first robotic milker going in Cumbria, and it was like the industry was abuzz with this crazy new thing. I think, roll the clock on, and although we're sort of 16, 18 years on from that point, probably 6-8 years into the sort of advent of robotic milkers in the UK, coming more commonplace, they never raise an eyebrow now. And I suppose the message there is, what is today's innovation and today's tech actually becomes tomorrow's every day. So with that, I will hand over to John Maycock, who works for Propel Asset Finance. Over to you, John.
Thanks very much, Oliver. Appreciate the handover. So yes, John Maycock, the Commercial Director for Propel Finance. We're an independent lender that work through a series of partnerships, as Adam's just mentioned earlier, partnerships with Barclays and with Assets. What do we do in basic terms? We help companies who want to invest in items of capital equipment and spread that cost over time to make it affordable and not too much of a drain on cash flow through cash purchases. And we support businesses across multiple industries, and from small to large, and typically our lend sizes for asset finance range from about £5,000 all the way through to a few million, depending on the nature of the business that we're lending to. We built up some good expertise and good affinity and empathy for the agricultural sector, and think there's aspects of your businesses that we understand well and some of the pressures that you're under. So how does asset finance support innovation in this sector? I think the first thing to kind of say is perhaps that asset finance itself isn't a particularly innovative product. It's been around for ages. It's very simple. And as I say, essentially helps people pay for capital expenditure and spread that cost over time. Historically, it's been deployed to finance the more traditional assets, the wheeled assets, the tractors, the harvesters, whereas now, certainly through many lenders, including Propel, it can be deployed a little bit more innovatively to provide a great solution for farmers and businesses operating in the agricultural ecosystem to finance many different types of kit and to solve cash flow challenges in different ways. So at Propel, we like to we seek to find solutions to help agricultural businesses invest in equipment that they need, as well as in the assets they already have to help drive their businesses forward. So a few examples of that, or a couple of examples of that. We recently had a customer that was seeking to finance a sheep shelter, effectively, not a full-blown building as such, and therefore trying to find property mortgage solution for that was not applicable for that customer. Effectively, quasi-temporary building, not a particularly great asset for us to look at in terms of in the event of demise of that business and having to repossess it. It wasn't going to be great for us. But that business had 3 unencumbered John Deere tractors. So a farmer down in South Wales. We were able to refinance those tractors, provide them with the cash, and they used that cash to build what they needed to help extend their business. So basically deploying the asset finance product to solve the solution for the new expenditure they had. Additionally, you mentioned there, Oliver, around financing robotics. This is something we look at regularly. Every week we see new inquiry for whether it's milking robotics or recently a farmer we had in Wiltshire that needed to invest in some chicken feeding technology. And actually, the investment they had in this project, we were able to finance the technology for them, finance the installation of that project for them, and their reduction in labour costs, increase in productivity, more than offset the cost of what they were paying on a monthly basis for their hire purchase facility with us. So certainly we can see ways in which we can deploy asset finance to try to find the solutions to help spread the costs and invest in the technology that businesses need. So essentially, asset finance is a far more versatile product today than it perhaps has been historically. And it's also an alternative form of finance that will be incremental and additional to your other lines of credit, perhaps with your bank or perhaps with the manufacturer supplier finance that you'll find very prevalent for new assets. Help frees up cash flow, spreads the cost of purchases, and enables your business to invest in state-of-the-art technology to help drive the cost down and keep you operating efficiently. Clearly, we'll end up with multiple questions, so look forward to those as they come through. But I'll now pass you on to Liz Jones from Assets.
Thank you, John, and good evening to everybody. I just want to briefly touch upon the sort of tax relief available on any assets that you might have financed for the farm. Obviously, there's various different types of assets. We've got land and property. We've got movable buildings. So, for example, mobile chicken sheds, the standard plant and equipment, which would be your tractors, that type of thing. And then, obviously, the farm vehicles. So they may be the standard cars or pickup trucks, that type of asset. So obviously, looking at tax relief, we've got the annual investment allowance at the moment, which gives 100% relief against the cost of assets up to a limit currently of £1 million per year. That's actually set to reduce back down to 200,000 with effect from April 2023. Now, the government have sort of touched upon looking at that, reviewing it, maybe putting something else in, but we don't actually have any further details at the moment. If you go above the £1 million, or you've got a sort of pool on your tax allowances, you can get allowances at a rate of 18%. And obviously that then will give relief against the tax burden on the business, so helping free up the cash flow again. We've also got for limited companies only, there is a super deduction available. And what that does is effectively gives 130% of the cost of the asset against the taxable profit. So if you spend 100,000, for example, you'll actually get a 130,000 deduction for tax purposes. The downside of the super deduction is that it's only available on brand new equipment. So any second-hand purchases won't qualify for the 130% relief. Ex-demo items do fall under the category of new for these purposes, but it is also only available to limited companies. So it's quite restricted, and that in the same way as the annual investment allowance is set to end on the 31st of March 2023. So where does this come into effect for farm finance? Well, looking at the availability of this tax relief, so the capital allowances, does depend on the timing of the purchase. So to qualify for the relief, the item has to be paid for in full. If the payment is due more than 4 months after the order or the contract date, then the relief is only available on the date of delivery. But more importantly, if you're purchasing on hire purchase, the item has to be on farm, delivered and brought into use before the relief is available. Now, obviously, we're all aware at the moment we've got significant delays in delivery and availability of plant and machinery. Sometimes this is up to sort of 12 months or more. Now, if you're looking to finance, you want some tax relief, say, in the current tax year, but actually the item isn't going to be available before the end of the tax year. If you're looking to put that on finance, actually you won't get the relief until that asset has been delivered. So quite a lot of delays there. But perhaps looking forward, if you're partway into the tax year, you think it might be a good year, maybe start thinking now about looking to buy those assets to have it on farm delivered before the end of the tax year so that you can actually qualify for that relief. We've also got to look forward to, or project forward rather, to the April 2023, when those allowances do reduce down. So the super deduction will end for limited companies. As I say, the annual investment allowance of £1 million set to go back to just 200,000. If you are investing in something with relatively significant cost, is that actually going to be available by the time we get to April 2023? And if you're looking to finance that, will that be on farm before we hit the end of those really quite generous allowances? So it's really just a question of thinking forward, planning ahead, and trying to work around those delay times that we've got to take advantage of the tax allowances before they come to an end or before they drop back quite significantly. So that's just a brief touch on the tax side of things. I will hand back now to Adam, but there are questions, I believe, at the end, so we can pick up on more items if anybody would like.
Brilliant. Liz, John, Oliver, thank you. Some really interesting takeaways from all of those sessions, really. And I think I've certainly learned a few things, that particularly on the taxation side. So we'll now open up for questions and answers. And just a reminder again that you can ask a question in the bottom panel. And for those of you watching live, so if you've got a question for any of our experts on the call today, we'll do that. We have been inundated with questions, so we have got quite a few to cover. We've got quite a few to cover. So I'll start with a question really for the whole panel. And I think this is a very pertinent question for farmers that I'm talking to at the moment. So it's from Tom Sterling. I'll say a name, but I'll probably pick up a few other questions within it as well. But Tom's question is, should I invest in a new, much needed cattle building, even when steel and other building costs are so high? And how would you recommend financing such a project? So Oliver, I'll come to you first.
Excellent. Thanks, Adam. I suppose I should have explained before I started speaking that due to a few tech and IT problems, I'm only on dial-in, hence you're all very lucky you haven't got to look at me speaking. So should you invest in a new beef shed? I think by the sounds of it, I think the phrase in the question was it was much needed. So I think for me, it is going to be a bit of a boring banker answer, I'm afraid, Adam. I think you've got to sit down and look at the numbers. What's the cost of the building? What are you going to gain from it? It almost becomes like a partial budgeting exercise. You know, you put the costs of that building on one side of the page, and you put the benefit you potentially may gain on the other side of the page. So obviously we don't really have detail on the type of beef operation, whether it's buying in store cattle or it's sucklers. We don't really know. But I think you've got to be able to see some sort of gain from it, as I talked about, you know, a return on that investment. And as I said, it's not always financial. Now, any debt a business takes on, that business has to be able to service that debt from trading. Otherwise, you know, that's when trouble starts and debt starts to snowball. So what I would say is, I think it's important to assess the current business, see what sort of excess cash is being generated after all business costs, including drawings to the farmer. We all need paying for what we do, and any capital reductions in any other facilities or asset finance that are there, and then see what's left over in a usual trading year. From that, you have a good discussion with an agricultural relationship manager. They'll be able to give you an idea of how much money you can borrow, and then you can see what sort of shed you can put up for that money. Then you can start to add in potentially what efficiency and financial gains you might get from investing in that shed. And maybe potentially there's other uses for the old building. If it's not suitable as a modern beef shed at the minute, it might have some sort of diversification added value, storage, who knows? I don't know how big the shed is, but, obviously with the correct planning permissions for change of use in place. Is it wise to invest in a business? I always think a business that doesn't invest in itself is a business that's going to stand still and eventually paddle backwards, if I'm honest, Adam.
Okay. Thanks, Oliver. Liz, any views from an accountant's perspective?
Yes, certainly. I mean, the putting up of a cattle shed, because in nature it's fixed, it's not movable. For tax purposes, it doesn't actually qualify as plant and machinery. So you won't, although it's a relatively substantial cost or a substantial cost, there's no tax relief for the cost of the shed itself. So all the steels, the concrete, those types of things won't reduce the taxable profit. So if you are having a good year and you're using the benefits of that good year, if you like, to get the financing to fund the cattle shed itself, don't then think that you're going to get tax relief on that at the same time, because sadly you won't. The only thing that you can bear in mind is anything that you put in the shed that's movable, so gates, hurdles, that type of thing, as long as they're put in and can quite easily be taken back out again if you wanted to, so further down the line perhaps to turn it into a machinery shed or something like that, you can claim the allowances on those movable bits and pieces. So important to get that invoice separately, because it's much easier to prove that the distinction in cost or the allocation of cost between the fixed element and the movable element if you've got separate invoices. But the actual cost of the shed itself, sadly, there won't be any tax relief on that. There would only be relief if you come to sell the farm or property at a later date.
Okay, brilliant. Thanks, Liz. John, any views from you from an asset finance perspective?
Well, I agree with everything said to date, and clearly, assuming that from Oliver's assessment you've decided to invest. I think the options there are a couple of things from an asset finance perspective to consider, which is perhaps if there's equipment going into the shed and some of the items that are movable, they may well be, as Liz says, if they're on a separate invoice, we may be able to provide some asset finance against those items. And then secondly, in terms of how do you intend to finance the cost of the fabrication of the shed, and whether that's through term debt, whether that's through, probably not through overdraft, because you've got, you probably shouldn't be using working capital to finance a longer term asset. But there may be some release of equity you've got in existing assets, plant and machinery, that you may be able to refinance through asset finance. But essentially, you've got to look at all the options and see what stacks up best for your business and cash flow.
Excellent. There is a follow-on question from this, and I think we'll probably open this up. So from Andrew Wilson, which is interesting answer. How would you advise budgeting for a shed as you describe in a time of huge volatility in costs and prices? So Oliver, Liz, I'll perhaps open that up to you, because with prices constantly changing, how do you work out how much it's going to cost you? How do you budget that? Is it worst case? Is it best case?
So I'll pick it up first, if you like.
I was just going to say, go first. No, you carry on. That's all right. You go first.
Yeah, no bother. It's a really good question, and it's often a retort we hear, not just as agricultural bankers, but bankers in any sector, in any business. I'm going to look at it from 2 points of view. So if you look at it from drawing up the budget to see what the benefits of that project are, beef price changes. We've seen what's happened to an awful lot of the input costs. Not just for agriculture, but across the board and in domestic homes. It is really hard to budget. And I was speaking on a webinar yesterday when I said when I was in consultancy, there used to be a little bit of a joke of when is a cash flow budget out of date? As soon as you've saved it and printed it,
Indeed.
Because something will change the very next day. What it does give you is it gives you the power to say, actually, let's say you put a budget together last summer and you put fertilizer in at $350 a ton. Actually, if that fertilizer goes to $650, $800 or £1,000 a ton, it easily allows you to make that adjustment in an Excel or some sort of spreadsheet, and it just shows you the impact that it's going to have on your cash flow in the coming year. What that then gives you is a really good conversation point with your bank manager to say, right, this is the input cost. This is how much it's gone up, and this is what it's going to mean to my business this is the increase in working capital I'm going to need. And that's a really impressive conversation to have with a bank manager. I think if you look at it from the budgeting from the cost of the shed point of view, yeah, I think you need to do your homework first, work out how much you want to borrow, how much you can afford to borrow, whether that gets you the building you want, and if it does, nail that down in a fixed price contract wherever possible.
Excellent. Liz, anything you'd add to that? But also, I have got another tax-related question for you in a moment. So anything you'd add to
Okay. Yeah, I mean, really, just to follow on from that and reiterate the importance of the cash flow forecast. And I think if you're looking to budget for something like a shed, obviously, as you say, things can change on a daily basis. So it's really a question of making sure that before you go ahead and make the investment, prepare those cash flow forecasts and build in some sort of flexibility so that you can have a look and say, well, okay, I can afford it at today's rates and today's prices, but if things go up by X percent, can I still afford it? And just to have a look and sort of build a buffer and say, well, okay, I think I'm still okay if costs go up to a certain extent, and then really just make the decision based on that, and that's as best you can do, because as you say, things do change daily. So it's really just a question of saying, well, okay, if I can only just afford it at the moment, probably not sensible to go ahead at this stage. But if I can afford it comfortably at the moment, even allowing for those increases, if that still allows me the repayments, then it's looking as good as you can get at the moment.
Okay.
I think another thing to mention, Adam, which should have been in my original answer is, and Liz has just touched on it there, when we get into the bigger projects that we're financing, maybe even six-figure investments into 100, 200 and beyond thousand, we do tend to build in a 15-20% contingency. So you can imagine if you're digging a building out and you suddenly hit rock you weren't expecting to hit, that's going to add to the cost. So as a bank, we wouldn't lend the exact figure. We'd want a facility that was 15-20% higher, just in case that project ran into some of those difficulties that Liz has mentioned or I have.
That's sensible advice, and yeah, absolutely, building contingency, but it comes down to, I think the key thing I've heard is, if it's the right thing for the business and it's going to deliver value, then you work through that plan of how can you make it happen and be comfortable. Liz, I'm going to come to you because there's a question, and it interests me actually, because I don't know the answer to this as well. So it's from Thomas Ivings from Messer Ivings, regarding the super deduction for tax. If you subsequently sell the asset, how much is taxable at that point? So as an example, you've paid £100 for it, you've claimed 130, you sell it for 60. Which is the taxable amount? How does that work?
Okay, so when we claim allowances, when we're buying an asset, as rightly is mentioned in the question there, when you sell the asset, the proceeds effectively become taxable. Now, if you claimed 130% relief at the date of purchase, if you sell that asset before April 23, then we have to calculate the proceeds or increase the proceeds to the point of 1.3. So if you're selling for £60, times that by 130% becomes £78. So that would be the figure that you include as taxable income or put on the tax computation when you're calculating the tax adjusted profits for the year. Once we get beyond April 2023, the rate of corporation tax is actually set to increase to 25%. So then you don't need to make such an adjustment, because you claimed relief at 130%, but corporation tax was only 19%, which is the current rate. But when you're selling the asset after April 23, you're paying corporation tax on those proceeds at the higher rate of 25%. So it depends really when you sell the asset.
Okay, excellent. Thank you. Hopefully that's covered it. It's very straightforward, actually. So we're going to move on to another question now from Robert Maitland-Bidoff. And this is a question, again, there's quite a few around this subject. So the uncertainty around ELMs affecting farm finance, are farms going to be able to use financial instruments to finance the increased costs of their inputs, aka fertilizer, over the coming few years? So I think the question is, there's uncertainty around ELMs, BPS, the changes there. Obviously, markets are quite volatile at the moment, both for inputs and outputs. So I'll probably come to all of you, because I think everybody can add something to this question. But Liz, do you want to go first on this one? We'll stay with you.
Yeah. So from a tax perspective, sorry, just run back over that.
So
really
is there any financial instruments where you've got increased costs of inputs? I guess from your perspective, is there anything from a tax perspective that you should consider? Is there anything from an accounting perspective when you're looking at increased inputs but uncertainty around what's going to be coming in?
Yeah, I mean, the main consideration there really would be perhaps ask yourself why you're financing that in the first place. Because if it's got to the point where you're having to use finance to purchase the fertilizer, etc., is that because, for example, you've got to pay out for those items before things such as single farm payment comes in, or sorry, basic payment scheme rather. So it's really just a sort of timing difference, or is it that actually costs have gone up so much that you are really struggling, in which case do you need to have more of an in-depth review of the business and say, okay, hang on a minute, where are we going over, where can we make some cutbacks, that type of thing. But if you do go down that route and that's the right answer for your business, then from a tax perspective, you would get the relief for the cost at the date you incurred the costs, so right at the start. The effect of the finance, so the repayments, there wouldn't be any tax relief on those repayments because you've had the tax relief on the full cost up front. But any interest that you incurred, you would that would reduce the taxable profits, and you would get tax relief on those interest payments.
Okay, excellent. Thank you, Liz. And Oliver, anything you'd from a financial instruments perspective? Is there anything you'd recommend or consider?
Yeah, I think Liz touched on it. I suppose if I played the banker persona, which is what I am, I think you've got to start assessing whether a business has two sources of capital to it. It's working capital, which is the day-to-day operational costs, so things like fertilizer, feed, spray, etc. And that should be funded through overdraft or cash held in the business. And it fluctuates. It goes up and down as the trading cycle continues. The other type of financing and money capital coming into a business is obviously that sort of capital expenditure type thing. So whether it's a tractor, whether it's a building, you could put breeding stock down in that bracket. But, so it's about funding something over its useful working life. So for me, if you're looking at fertilizer and looking at putting that on a 2-year facility, say, so that you can afford to buy it, there's a challenge there from a banking perspective of, well, why aren't you going to make enough money to pay that off as part of the normal working capital cycle? Admittedly, we've seen huge increases in the cost of fertilizer. It's up threefold, come back a little bit now, and speaking from personal experience, my electric tariff has gone from 18.5p to 49.5p. You start running a large scale farming operation, and that can make a big difference to the freedom of capital, working capital in that business. So occasionally, as we've seen in the last sort of 6 months with those costs shooting up, there may be times that you need to have that discussion with that says, actually, these costs have gone up so much that I'm actually going to need to put some structure around this. Yeah. I think from a banking perspective, it's still working capital. So we would probably still like to fund that through an overdraft. So the financial instruments side of the question, is for me, it would have to be overdraft, but that's me coming out as the pure banker. And again, just to go back to one of my earlier answers, this is where a cash flow budget comes into play. A cash flow budget, it's not like a balance sheet that's a snapshot of the business on that day. It's a living, breathing, working document. And if you've got that cash flow budget, well, yeah, fertilizer price has tripled, but the grain price has gone up by more than double. So in order to get that facility from the bank, you've got to demonstrate the money going out. But hopefully when you get to harvest time or the next milk check or the next milk price increase, you can also demonstrate that working capital cash comes back through trading.
Okay, thanks, Oliver. And John, I guess from an asset finance perspective, we traditionally see that as here's a piece of kit, here's a bit of finance, I need some new kit. Is there any way in which Propel can support with that if you're looking at increasing costs and financing those?
So the first thing I'd say is I'd go back to Oliver's point with regards to financing assets over useful working life, and therefore you don't want to mismatch in terms of raising debt over a longer term when actually those inputs are going to be used much shorter term. You then end up with a debt burden in the business that's not sustainable. So probably would defer to the working capital credit providers, either the banks or some of the specialist input finance pieces for that. That's not to say that we wouldn't try and find a solution, and maybe if there was a shorter term piece of asset finance we could provide. But ultimately, I think it's trying to match the right type of finance for the right type of need. So probably asset finance is not the right call for that need that we talked to.
Okay, excellent. Thanks, John. We've got a question now from Rachel Raw, and just a reminder, you can pop questions. We've got quite a few of them coming in now. You can pop your questions in the bottom panel. This is one from Rachel. The BPS early exit lump sum scheme will help older generations retire, and that scheme I think is open till the autumn now. Are the panel aware of any young farmer support schemes and incentives to help the next generation take over, those that are leaving the sector? I know if I speak to George Dunn, there's also a focus on being able to help smaller farmers grow into bigger farms. So I think there is an opportunity there. But Oliver, I'll come to you first. Is there any schemes you're aware of or anything on the horizon?
So there's a couple of things I can talk about here, Adam. One is I'm actually on the steering group for a project that goes across the whole UK called the Newbie Project, and it's all about trying to get young farmers and new blood into the industry. As I'm now a man of a certain age, I always argue in the steering meetings that we shouldn't be putting an age limit on people wanting to get into agriculture. We should just be happy with new entrants trying to get in. But so there are projects like that, and it's a great organisation. They have competitions throughout the year. They have study tours across Europe and things like that. So that's good encouragement. I'm sensing from the question that we've talked about the exit scheme. Again, Adam, as you're well aware, we are in quite a lot of dialogue with DEFRA as well as other farming organisations. There's not been a massive pickup in that, or take up in that would be the phrase. But it certainly serves a purpose for some who don't have succession and don't know which way to go at present. As to whether there's any financial help, which is I'm guessing is the term of the question, not currently. The reason for mentioning we do have regular dialogue with DEFRA is not just us, but all the main high street banks talk to DEFRA frequently as a group, and we have discussed that a new entrant scheme with some sort of financial support would be a good thing from the industry. We know that agriculture, the capital expense of getting in, even on a small scale, is very, very huge. It's a real challenge for banks. I said it in my intro, banks fund businesses, not ideas and concepts, when we're at the sort of grassroots level of agriculture like I work in. So anything that can come along to support either bank lending with some sort of bank guarantee, like the European loan guarantee, small firm loan guarantee scheme that used to be in, anything like that would be very welcome by the banking sector, and it'd be a great thing. It'd be a great thing for UK agriculture to have some sort of help for people who desperately want to get into agriculture, and there are a lot of people out there. So that's the long answer, Adam. As you know, I always give the long answer. The short answer is no, but watch this space. We believe it's coming.
Thank you. And I'll come to John then, because I think from a more practical perspective, I guess, and this builds on that question, John, is if I'm fortunate enough, I've got an FBT, I'm starting out as a young farmer for the first time. At what stage would I be able to come and talk to Propel about buying equipment, buying potentially some of the other assets that we've talked through today?
So typically, and I think that most asset finance companies, most banks are seeking to find businesses that have been trading for 3 years. They've got track record. That said, we try and take a different approach and try to find solutions. So we are, in select scenarios, we're able to finance businesses that are newer starts than that, where we can see that there's strong backing behind them. Where they've got perhaps it's particular contracts that are evidenced, and where perhaps for us, whilst we will always look at cash flow as first method for repaying any debt that we're putting into a business, we also recognise that we're financing an asset that will have, worst case scenario, will have some realisable value. I don't want to get to that worst case scenario, but in certain circumstances, we can look at that in terms of how much risk over and above what value the equipment's providing us are we taking that business, and how can we help that business get off the ground. But those cases are slightly harder. So clearly copying Oliver here. Long answer as described. Short answer is typically 3 years and more. That said, for farmers that are operating and have shifted perhaps from partnership into limited company, and they've got long track record on the partnership before, that's a lot easier to translate, because you can see the historic history of the previous partnership.
Brilliant. Thanks, John. And Liz, I've got another question just popped in from Sean Yeats, and I think it kind of builds on that, but it goes back to some of your previous points. So Sean's asked a question about the timing of delivery of asset, and he was told at a previous firm that if the order for the asset wasn't cancelable, then allowances are available at the date when the order was made, regardless of when it was on site. Is that still correct, or has that changed?
No, that is still correct and hasn't changed. But with that one, it's always a little bit tricky, because when you look at that in practical terms, if you enter into a contract whereby, regardless of whether or not the asset ever arrives, you will pay for it, realistically, would you actually sign that contract? So what they're basically saying is if you sign a contract that says, I am obliging myself to pay for this asset, and you know what, if it never turns up, or if the condition is faulty, I'm going to pay for it anyway. Yes, you would get the relief at the date the contract is signed, but are you actually going to sign a contract that says, even if it doesn't turn up, I'm still going to pay for it? So yes, technically that is correct, but in practical terms, would you actually sign a contract to that effect?
Okay, that's good advice. Thank you. So John, I'm going to come to you, because this is, again, there's a common theme here around increasing prices, availability, supply chains, which I'm sure we're all seeing in our daily lives. But the lead time on new equipment, and I think Liz mentioned this as well, is very long. Certainly, I'm waiting for an electric car for nearly 2 years now. Do Propel help with second-hand equipment? Is that an option? And then I've got a further question after that, so I'll come to you.
Yes, definitely. So we actually see that there's a significant portion of new assets that will be financed through original equipment manufacturer schemes or dealer schemes, because the businesses manufacturing those assets are wanting to get their product through and into the market. And quite often the finance available on new equipment is subsidised by the manufacturer. It's hugely competitive, very advantageous for farmers to take that finance, because it's at an interest cost basis, can be either interest free or very cheap. That said, we're able to provide finance for new equipment as well, but we also see strong demand for finance of second-hand assets, which typically doesn't come with manufacturer support. We're able to provide finance against that. And to some degree, we see from an asset security perspective, a lot of the depreciation in that asset has already happened. And therefore, it provides us with good security. And being an independent lender, we're kind of making our own choices around financing those assets. We've got expertise with asset management experts to ascertain useful working life, and we're able to finance some assets over that may be particularly aged by the end of the financing term, as opposed to saying we'll only finance that piece of equipment up to 10 years age. We can finance assets that will be older than that at the end of the financing term. So yes, we like those opportunities. Clearly, to make sure that the kit's going to be in good working order and provide the services to the farmer that it's expected to. But we're happy to finance second-hand equipment.
Okay, and a question that's come from Matt Gard, actually. Could Propel cover sale and leaseback? Is that an option?
Yes, absolutely, and we do that regularly, and that takes two forms. So there's either sale and hire purchase back, or sale and finance lease back. And I might need to defer to Liz in terms of providing the tax advice on those, but essentially a lot of that is whether the VAT is being paid upfront or over the life of the with monthly payments. I do note that there was another question I think was from Adrian Williams in the list there, who'd had a poor experience previously with refinance of existing assets. And I think what's really important as you look at any contract whereby you're refinancing existing asset base to release equity in it is really understand not only what does it cost you in terms of the monthly payments. Therefore, yes, it's great, I get my cash injection day one. B, are my monthly repayments, because I've increased my indebtedness, are they affordable for me? And does that do what I need to do for my business? But thirdly, critically, what happens at the end of the 3, 4, 5 year refinancing period in terms of who owns that asset? Am I clear that that asset then comes back to me for a small title charge of £50 or £100 or whatever's negotiated in the document? Or does the financier own that asset at the end of that period? And am I okay with that or not okay with that? Because otherwise you could find yourself paying a rental charge to the financier for in perpetuity, which is clearly not where you want to be, because you're beholden. So really understanding the full life cycle of that contract, I think, is important. I'm happy to pick up the specifics of that case privately if need be.
Excellent. Thanks, John. And we'll talk a little bit more about robotics and technology, because I think that's a question that's come through. But Liz, if I can come to you, there's a few questions around this, and particularly with a number of grant schemes that are available at the moment. There's the option of funding. And this question is from Mark Turney, but a few people have asked it in different ways. Can you get tax relief on assets financed by grants or funding specifically? In his case, cattle crush and handling equipment. So if you take a grant, how does it work in terms of tax relief and some of the things you've already covered?
Okay, so the grant basically reduces the cost of the asset for tax purposes. So if you buy an asset for, say, £10,000, but you get a 40% grant towards that, so then you receive the grant monies of £4,000. For tax purposes, the net cost of the business is £6,000. And you would get the tax relief on that £6,000. So we basically take the cost, deduct the grant money that you've received against that. That's the net cost of the business, and that's what you get the tax relief on.
Excellent. Very straightforward. Excellent. Thanks very much. Okay, so we'll talk about robots and technology, because it's called Innovating Farm Finance. It would be a shame not to talk about something innovative, and I know Oliver's touched on it at the start. I'll perhaps come to you first, Oliver, and it's a question from Kirk Steidemann-Walter. In the changing landscape, how much do farmers need to invest in robots and technology to remain profitable? So, Oliver, I'll come to you first.
Gosh, that's a great question, isn't it?
It is. I thought I'd catch you out.
Yeah. Thanks, Adam. Cheers. Thanks for that. It is a great question, and it's a question on the lips of many, not just farmers, but obviously us as a bank. I suppose it depends on the business. I've been to businesses that can use photography to sort potatoes into different sizes and weights and all the rest of it. I've been to fruit farms, hop farms. I think it depends on where you draw the line on that technology, innovation, and robotics. Obviously, there are some cases in business where robotics, automation, and innovation and technology aren't going to be as deployed. I'm thinking possibly in the uplands. If you've got a load of hefted sheep in the Lake District, I'm not sure where the investment in robotics will come there. So I think it's an individual farm by farm basis. We do see that there are an awful lot of robotic milking machines, for example, if you go up the east coast of Scotland, and there's quite a few West Wales way. That's because they're trying to overcome the challenge of labour, which is obviously where an awful lot of robotic innovation comes in. It cuts the requirement for that labour. So I think, I feel it's a great question. I'd love to have the debate with the person who asked it, but I think it's a very farm-specific and probably geographical labour requirement type question. But I think we are going to see an awful lot of innovation and investment in technology, a part of which will be automation and robotics.
Thanks, Oliver. And John, your team will see lots of these examples and be involved in financing them. And I know for certain that we've spoken about a few, but are you seeing any trends from a Propel perspective?
Definitely. And we're seeing the ability for farmers to invest in technology across, a wide range of applications, essentially, and I think it comes back to what Oliver talks about, but to protect themselves against the challenge of recruiting labour and skilled labour, and touches on earlier point in terms of what are we doing to attract younger employees into the industry, and that's the challenge. But we've financed recently for a farmer. We financed some CCTV across their lambing units, so that they didn't have to have human being walking around checking on the welfare of the lambs. They were using CCTV, monitoring that centrally. They could then go to where there were any issues. So it's just not necessarily hugely advanced technology, but being able to invest in that to spread the oversight they've got over the farm. So yes, certainly, and we talk there around in terms of fruit farmers and picking capability. We're financing a lot of those types of assets, and from our perspective, it's really trying to get in and understand the nature of the business and what the technology does for the business. Because on the one hand, from an traditional asset finance perspective, everybody goes, it's great, I've got a tractor, I know it's going to be worth 20 grand, so as a lender, if something goes wrong, I've got my security. Whereas, what am I necessarily going to do with a bespoke piece of robotics with software, etc.? I might find that more difficult to realize my security. But essentially understanding the mission critical nature of that investment that's being made into that farm, and what it does to drive productivity and build cash flow for businesses, is all part of the solution that we're trying to get to. So yes, seeing huge increases in it, and the application of an asset finance product or otherwise, I think is a good fit for it.
Excellent. Thanks, John. And I think your point there, one thing I would stress out of that is that innovation doesn't necessarily need to be state of the art. And I know certainly I've spoken to a few farmers, and small pieces of technology can actually save significant amounts in terms of labour and things like that. So it is that, we all think innovation is this Elon Musk walking robot type thing. It doesn't necessarily have to be that. It's innovative for the particular farm. So I think that's a really good point, and well made. And Liz, I guess you'll see it from another side. Are you seeing any particular trends in assets?
No, I wouldn't say any particular trends. I think going back to what Oliver said, it really is very farm specific. We've got businesses that several years ago went down the robotics road. They put all of the technology in, and then actually found that they were causing more problems than they were solving. The repair costs, maintenance costs, etc., was actually outweighing the cost of the labour that they had in place previously. Then we've seen other businesses that have found the opposite, that actually their business had used so much cost-wise in terms of labour, that actually going down the robotics or the innovation route has led to a great saving. So it really is farm specific, business specific, and we are seeing both sides of it. Excellent.
Thank you. So a couple more questions. I think we've got sort of nearly 10 minutes left. And I'll save the most interesting one from Sam Sheikh till last, because it'd be good to get everybody's views on sort of the future of finance. But one of the things, and I think this is a series, and this may certainly be one of the next topics we cover, but I think it'd be good to touch on it. So we're seeing that increase in energy prices. The Chancellor today has been talking about support for consumers and for homes across the UK. How do I access finance to invest in renewable energy to offset my energy costs? Because all of a sudden that is becoming economical. And I think to your point, Liz, it may not have been, but now it is. So John, is that something that Propel do from a renewables?
Yes, we do. I would say that our core competency is asset finance, and it's definitely not project finance. So the renewables that we look at will be smaller scale. So we're not looking at financing, huge solar farms. But if there's solar panels going onto the roof of a new cattle shed, we can look at the finance of those solar panels. We've previously financed single turbine or small turbine units as well, and otherwise have kind of, whilst there's risks attached to it, and you need to kind of look at it all the way through in terms of is the solution going to deliver the savings that you expect it to deliver, but whether that's biomass or perhaps anaerobic digestion, there's an asset finance solution for that. I just think that through those things, ensuring that the investment that you're getting is going to give you the saving that you need is absolutely critical. But yes, we look at those. We clearly look at those in the context of the cash flow of the business we're lending against, as opposed to it's a project that's going to generate Y, and therefore, to Oliver's point earlier, we're not financing concepts, we're financing businesses and people. So that deploy kind of similar methodology.
Okay, thanks. And Oliver, I'm pretty sure you've got some views on this.
You know me, Adam. I've got a view on everything.
Unfortunately,
yes. Unfortunately for you and the rest of my colleagues and people I interact with, I didn't say it was right. I just have a view. For me, I think John's touched on it. Where we've got a project, and it doesn't matter whether it's arable beef, sheep, pigs, poultry, whatever it is, where we've got a project and that renewable energy project it fits with the size of the enterprise. So what they're trying to do is effectively hedge their risk against increases in energy price, which is where the question came from. There should be something the bank can do. What we would probably look at is we'd look at the potential for energy saving if the project was a little bit bigger and you could sell something to grid. But I think where we're at the minute, we would want to see the core business being able to service that investment in that business. And that's no different to, whether it's a renewable energy project, whether it's cattle handling system, whether it's, going to John for a combine, to finance that. It's whether that project fits with the business. Now, we can look at it. We can certainly do that on a sort of equity release basis that I spoke about at the beginning. But that core farming business is going to have to service that investment. Now, John touched on something. He used a phrase called project finance, where we've got something. Let's use an example of a 300-cow dairy unit, and they suddenly want to invest in an aerobic digestion unit that's 10 million quid. You're getting into the realms of project finance, and what that means is you don't particularly fund. You're not particularly funding the asset. You're not leveraging the deeds that asset's going to sit on. It's a very specialist area of banking, and if I'm honest, Adam, as you'll agree, no doubt, way above my head. But it's where you're actually, that funding becomes it's the energy generation and any potential income and premiums that will generate then becomes your serviceability. It's a very specialist area of lending. It tends to be quite expensive as well, and a lot of the time you need to be into that 12-15 million pounds worth of capital expenditure before any bank will look at a project finance type initiative.
No, thanks, Oliver. And Liz, I guess there'll be lots of farmers and businesses on the session today. How does it work from a taxation basis? So if you put solar panels on the roof, is there any tax benefits to that? Is there anything that you can claim, or is it already the things you've talked about?
No, it is. So solar panels actually for tax purposes go into what's called a special rate pool, which basically means they can be written down at a rate of 6% per year. So it's a much longer releasing for tax purposes. Historically, going back sort of several years, you were able to claim the annual investment allowance and put them through at 100%. That was restricted several years ago. As I say, that they are now specifically ring-fenced into a special rate pool. The same does not apply for some other sort of heat generating or energy generating assets. So, for example, a biomass boiler would still be treated as plant and equipment, so you'd still get the 100% allowances on that. But solar panels specifically do go into as I say, the special rate pool, 6% allowances. But any income that you receive, so if you're selling heat back to the grid, if you're claiming the allowances on the expenditure, the income you received is treated as income into the business. So again, potentially tax payable on that.
Excellent. That's really useful, because I think that's very, very useful for everybody on the call, because a number of people have mentioned that. So we're coming to the end now. I'm conscious it's just turned 6 o'clock. I've got time for one question, but I'm going to ask the panel to be quite succinct with this, because I think you could talk for days about it. It's a question from Sam Sheikh, which is, how do the panel see finance providers and lenders innovating in their products and services, given that there's a move away from traditional farming into new technologies. There was another question just around this is from Robert Bourne, around futures and options. We've seen, in the US, I've spoken to a dairy farmer, and they have a very sort of different system in terms of insurance. But Oliver, I'll come to you first, and succinct as possible, please, for the final question. Any on that?
Yeah, just to clarify, Liz and John know that succinct thing was directed at me, not them. So apologies, Liz and John, you've got tarred with the same brush. Really succinct. Agriculture around the world. Adam, and you and I have had so many conversations with banks and agricultural institutions around the world. Crop finance, crop insurance, forward selling, tighter contracts on supply in other sectors are quite commonplace. So if you look at the trend of agriculture over the last, doesn't matter how long you want to go back, farms are getting bigger and bigger. They're operating on more rented ground, more share farming, more contract farming. So from the point of view of agricultural finance and a high street bank, I think, in time, it's not going to happen this year or next. In time, we will move into what we would call more cash flow lend. So we lend against the contract of supply with the processor or retailer, and that contract would have to be tighter than they are at the minute. But also the backdrop of that to protect everybody involved will be crop insurance. It'll be forward prices. It'll be guaranteed income, providing you can operate within the margin. And then we'll be back to Campari of character, ability, management. Can that farmer deliver the specifics of the business plan with all that in place?
Brilliant. That was very succinct. Thanks, Oliver. I'm going to come to you, John. If your little blue sky hat on, what would you like to deliver from a Propel perspective?
So I'll use an acronym as well. So we refer to DIM. So if it's durable, identifiable, movable, saleable, it's probably an asset we'd like to finance. And it's therefore our innovation is not just looking at the trucks, trailers, tractors, etc. But we want to be able to finance technology that's going to help drive your business forward. Our innovation is also your time is best spent not applying for finance and filling out forms. We make the application process really slick and easy at Propel. We've built our own technology platform. Therefore, an application should take seconds to minutes, and an approval process should take hours with us. And the sign up and the execution is really slick and easy. So hopefully we make the access to finance much easier, and we'll stick to our knitting in terms of what we do, but we'll make it really easy to do business with. That's how we play.
Excellent. Thanks, John. That's music to my ears. And Liz, from your perspective, anything you'd like to see? Anything that your clients are talking to you about?
No, I think a lot of our clients really just sort of touching on what Oliver's mentioned. A lot of them are perhaps trying to get finance these days for more innovative projects. Lot of businesses, farm businesses, diversifying in all sorts of different ways and needing funding for that. So they are looking at they're looking outside the box. They're thinking outside the box. So it's really, getting going back to cash flow forecast. If they do go to these new projects, is it going to work? Is it going to pay? And therefore, if they take the funding out for that, will it all sort of add up at the end of the day?
Excellent. I think Liz, you've summed up today's session in two of your sentences there, which is think ahead, forward plan, and try and be innovative. And I think that's hopefully everybody's taken that from the session today. So that's all we've got time for tonight. We're running slightly over. Thank you so much to Liz, Oliver, and John for their time and expertise. The webinar recording will soon be available on demand. You'll get an email to let you know when it's ready for viewing. I hope the time you've invested this evening has left you with a greater understanding of farm finance, giving you some food for thought as to how to proceed with choices that you're making in your own business. And the following sessions, there's certainly some themes coming out. I think renewables and the sustainability piece. We haven't covered some of those questions tonight, so I do apologise, but I think that's a session in its own. So we'll look to that for the next one. On behalf of the panelists and myself, a huge thank you to all of you for joining this evening. Have a good night, and I hope to meet you all soon. Take care. Bye-bye.